Hey there, it is Corey here from Verse. I hope you are all going tremendously well and hopefully enjoying a bit more time outside with family and friends and a bit of socializing. Thankfully, these restrictions are finally easing and life is getting a wee bit closer to normal. Now, today we have an absolute treat in store for you. I am joined by and going to introduce in just a moment Andrew Hubbard, who is one of the directors and accountants at One Ledger, which is one of the finest and fastest growing accounting firms in Melbourne. Andrew will tell you a bit about himself on One Ledger in just a sec, but I have asked Andrew to join us today to give us some advice and guidance and some valuable tips for the business owner clients we have here at Verse. Obviously, June 30 is coming up pretty quickly. This is the time of the year where we plan our tax and make that as effective as we possibly can. This year with COVID-19 happening, business has probably never looked different. There are a whole range of stimulus measures in place from the federal government as well that many of you are going to be somewhat or very familiar with. So Andrew will touch on some of those today. But before we dive into the detail and the tips, Andrew, welcome. Thanks for joining us. And I see you're in the Port Melbourne office there. I know you've got your first child. You and the lovely Danielle, your wife, expecting your first in just a couple of weeks. So probably the last bit of time you're going to get to spend away from home for a little while, I anticipate.
Yeah, absolutely, Corey. Look, thanks for having me. Look, you've got all the things happening at once. You've got COVID, you've got tax time, and in 3 weeks I'll be expecting my firstborn baby. So it's just a mental time at the moment navigating all of that. But
I would have thought an accountant would be better planned than having a baby like bang on end of financial year. To me, that doesn't make a lot of sense. I thought you were better at planning than that, Andrew.
Well, you know me very well, Corey, and I do like to plan, but there's some things you can't plan, and this was one of them. But look, could not be happier. Look, we only got married a year ago, so we celebrated our 1-year anniversary 2 weeks ago, and in 3 weeks we'll have our firstborn, which is just we're both really excited at the moment. Can't wait.
Congratulations. Tell us a bit about yourself. And just give us a bit of background very quickly on One Ledger. What kind of clients do you look after? And tell us a bit about the team and the work that you are doing.
Yeah, of course. So One Ledger we started about 7 years ago. Business partner Hai, Trang and myself. So we knew each other from some pretty big places, pretty sterile accounting firms back in the day. And after breaking free from that, we decided, look, there was a real gap in the market for SME clients and getting their hand held through the journey. So we've come up with a tagline that, we want to be part of people's story. It's not about just giving advice and saying, here you go do it. We're a bit more proactive and, just holding their hand. Our typical client, they're probably, 25 to 40 years old. They're running multiple businesses or one, high growth sort of business. And, we're just there with them. Accounting has changed a lot. So we're, very much there daily. It's not just, running a P&L or a balance sheet. It's more that sort of financial strategy, much as you do for some of your clients, your individual clients. We're doing that for our business clients.
Great. Fantastic. And in terms of those business clients, I know that you've got some business tips and some tax planning tips that you want to share that you think are timely and relevant at the moment, given the circumstances that we're in. So I'll leave it to you to start that presentation, and I'll probably have a few questions for you on behalf of some of our clients along the way.
Yeah, fantastic, Corey. Well, let's dive into it. As Corey mentioned, it's interesting times at the moment. COVID has changed the business landscape dramatically, right? So our tax planning discussions have changed. It's been very unique in terms of what are we actually doing before 30 June. A lot of people out there may not have the profits that they previously had, and that might open up a lot of tax planning opportunities. As some of you will know, the tax planning is often a waiting game. So sometimes we're waiting for the right opportunity to take money out of your business. So I'm finding for some clients, this might be the actual perfect time to do that. So every business is different. So today I've just assembled a few different topics which I'm finding are attracting the most amount of questions from people. And we'll run through a few of those. Corey, if you've got any questions, just jump in, mate. And yeah, we'll kick it off. So the first one I really wanted to run through is JobKeeper. So obviously this was one of the single biggest support packages that the government released for businesses. And I'm sure most of you know, the broader ways to get into JobKeeper. Your business has to be down 30% on a comparable period. But I just want to touch on a few things that even though we're a couple of months into JobKeeper now, you might not have gotten in yet, but you can get in all the way up to September. So you might find that your business hasn't suffered yet that 30% drop, but we are finding that we're registering people a bit later. So, you might be eligible for the May period, you may be eligible for the June period. And once you're in, you're actually in for the rest of the JobKeeper program, which is scheduled to run till the end of September. So it's something to keep in mind, and keep an eye on your revenue, keep an eye on what you were doing last year, and don't discount it just because some of the enrolment periods have already ended. So that's what I wanted to touch on with JobKeeper. The other side, if you're already in the program, you've obviously got employees who you are paying through the JobKeeper program. So what that would mean is you're paying them $1,500 at a minimum every fortnight. Now those employees might be at home, they might be working for you. And what we're sort of finding with current clients is some of those employees who are working or who aren't working and you are paying, we're finding that, it might be a struggle to actually get them to do things. And so we're having some interesting conversations just around what you can and can't do with your employees. And you are allowed to actually change the nature of their role or where they're working from. So, from our point of view, we just want to make sure that employees, who are getting JobKeeper payments, they are doing some work. And it's a great time to, get them to work on, your digital marketing, or get them to get some, to provide some insights as to how you can improve your business. I think it's really important that you get those employees, involved in the business in this time, especially when you might not have as much work on as before.
So are you seeing, Andrew, some businesses out there that have maybe stood down employees, then they become eligible for the JobKeeper, they're making the $1,500 per fortnight payments, but they haven't actually re-engaged with the employee to maybe give them some new duties?
Yeah, absolutely.
Okay.
It is common.
So a wasted opportunity, time to maybe get a bit scrappy.
Exactly right. So there's a lot of things you can be doing. And there's other strategies where you can even look at paying out some annual leave. I mean, there are rules around that, but you can be looking to pay down annual leave for some of your staff that are on JobKeeper. And so the idea of JobKeeper is making sure your business is stronger on the other side. So by reducing your annual leave provision and liability, that's a great way to come out stronger on the other side. Does that answer the question, Corey?
Yeah, absolutely. Happy to keep moving, Andrew.
Cool, mate. So the ongoing compliance with JobKeeper, you look around that, you're just making monthly declarations. There are tight turnarounds on that. So if you are in a program, just make sure you are making those declarations nice and early. You'll make sure that the government pays you nice and early. If you do delay a week, they will take a week longer to pay you your money. And then the other thing I just wanted to quickly touch on is the government has made some changes to the JobKeeper program. And so that was made just around childcare. Childcare workers are no longer eligible, and they have flagged potential changes to the JobKeeper program. What I'm expecting that to be is if your business has bounced back and you are seeing the revenues that you're seeing previously, there is a chance that they will wind back some of the JobKeeper eligibility. But look, that's yet to be seen. We'll find out a bit more about that in late July.
So are you anticipating that prior to the end of September deadline, they may actually wind that back in the interim to minimise the eligibility for some of the businesses currently receiving JobKeeper? Or are you saying they'll wait till the current, until the end of September and then they'll remove them from the scheme?
I think there's a chance they could wind it back before September, Corey. Yeah. And it's a good thing if your business has gone back to normal.
Yeah.
But yeah, I think there's probably some people at Treasury who think that you shouldn't be getting JobKeeper once your business is operating as it was pre-COVID.
It's hard to argue with. I absolutely agree, and I know that you do as well. It's been a bit of a moving target for the federal government. I know those estimates they initially had of 130 billion to the JobKeeper scheme, and I think that's coming at about 70 billion.
Yep.
And clearly the health crisis hasn't got anywhere near as bad as what we'd anticipated when the scheme was initially announced. So, making those changes on the fly, although a little bit messy and can be hard to follow for some, I think it's prudent because businesses that are generating perhaps even record revenues, might be on JobKeeper, and that's not appropriate.
Yeah, I couldn't agree more, Corey. So, I mean, look, some people are a bit worried that they might come off, and they are enjoying the JobKeeper payments. It's always good to have your wages, which are one of your biggest costs, reduced in your business. But look, if you look at the greater good, the government wants to reduce taxes over the next 5 to 10 years, and I'm sure those things will get brought forward if we're not spending money on things like JobKeeper, which is unnecessary in unnecessary circumstances.
Well said.
Thanks, mate. So anyway, just after JobKeeper, when we go into our tax planning discussions with clients, and when we're talking about business clients here, the first step is just really understanding what is your taxable income. And that can be very different to your accounting income. So what we will do is usually we will get a projection. And as we are sort of, we're getting into June now, you should know where you're going to land come 30 June. And once you do know that position, you would adjust your accounting income for any taxable income. And what I mean by that is, I'll give you an example. For some people most businesses would have received the cash flow boost. Corey, I know we got it. I'm pretty sure you would have got it. I think any business got it.
Yep.
And so basically that income is anywhere between 10 and 50,000. You actually don't pay tax on that income. So from an accounting point of view, you would have income, but from a tax point of view, that income wouldn't be there. So once we get to that position of knowing what our taxable income is for the year, we can then go about, all right, how do we reduce this? How do we make the most out of different things that are out there at the moment? And so that's what I'm going to sort of talk about next. Okay. So the first thing that we sort of talk about with our clients is around superannuation. During the year, you'll accrue superannuation for your staff members. Now, a lot of people don't seem to realise that unless you actually pay that superannuation, it doesn't become a deduction for your business. So if you've got unpaid superannuation at 30 June of 5,000, we would actually not claim that deduction. So your taxable income would go up by 5,000. So for us, one of the first point of calls is that we would tell people, all right, you need to make sure all your contributions up to 30 June are paid. Now, that would mean that your 30 June superannuation, which would usually be due on the 28th of July, we would actually bring forward that payment. So that would mean that we can claim a deduction for this current financial year. Now, some new rules around superannuation mean that we can actually contribute for individuals. You can actually contribute, you can carry forward contributions that you haven't used in previous years. So say we have some owners who haven't been paying their super, which is a lot of business owners who believe their business is their super. Say you've got a high profit this year, we could actually look at making contributions for that owner and basically utilise underpayments from previous years. So I'll try and explain that a little bit better. If last year you didn't pay any superannuation for yourself and you were a business owner, this year we could catch up last year's cap and this year's cap and claim a deduction for it this year. So if we had a large profit this year that we didn't know what to do and we had enough cash there to make a concessional contribution, we could look at, basically utilising 2 years worth of superannuation contributions.
So based on that annual cap of 25,000, which is the concessional contribution cap, you could do the $25,000 contribution for this current year, 19-20, and if you didn't make it last year in 18-19, you can do that as well. You're carrying that forward. So hypothetically, make a $50,000 tax deductible contribution to your super pre 30 June.
Absolutely.
Yeah.
Absolutely. And so what that would look like from a tax point of view is you're shifting money out of being taxed in the company at 27.5% to paying tax at 15% in your super fund. So you're getting an automatic win there. The trade-off is that, it's sitting in your super fund and it will be there until you're 65 or, for other reasons you can pull it out. But it's definitely one to think about if there is spare cash there and you are looking at boosting up your superannuation. So that's where we usually start with in terms of our tax planning. Another big one which has changed is the instant asset write-off. So due to COVID, the government announced that the instant asset write-off would actually go up to 150,000. And so what that means is if you bought an asset now before 30 June and it was ready for use in your business, you can immediately write that off against income. And so what would happen usually is you'd actually depreciate that over a number of years. So if it's furniture, you'd depreciate that over 8 years. But right now with the instant asset write-off going up to 150,000, you could actually claim the entire amount of an asset that you purchased between now and 30 June. So, you know, things that I'm seeing clients buy, you know, it might be a new van, it might be a new truck, it could be anything really. New computers is a small one, which we see every year. Servers, all sorts of things like that are what our clients are sort of looking at buying to write off some of their profit before 30 June. A lot of people were scrambling because they don't have the money to do that. The government had actually announced recently that that's going to be extended out to 31 December of this year. So if you don't get it in now or it can't be delivered in time, you know, you do have the option of claiming it next year as long as it's ready for use by 31st of December.
And does the asset that you purchased, does it need to be new or can it also be secondhand?
Can also be secondhand. So a lot of people are, you know, weighing up. One of the common questions now is, well, because of this write-off, I could actually afford maybe a new van as opposed to a second-hand van.
Yeah, I think I mean the instant asset write-off is great and utilised by many. I think what's really important to consider if you are a business owner is that even though you get the tax deduction for the depreciation much sooner, you need to make sure you really need that asset. It's not a reason to buy something. The reason to buy something is you need it in your business. It's going to help you increase your business revenues and grow your business. You just happen to be able to claim that depreciation all at once very quickly. So just making sure if you're going to utilize the instant asset write-off, you're not purchasing something because there's a for sale sign over it or a discount sign. You're doing it because you genuinely need it in the business.
Absolutely. I mean, well said, Corey. I mean, basically what we're saying, if you were going to spend this money in, you know, July, August, September, we're bringing things forward. We're not spending money for the sake of spending money. Yeah. At the end of the day, even though you get a deduction, like Corey said, you've still spent the money outlaying to buy whatever that asset is.
Yeah, well said. Great way of thinking about it. If you're hoping to buy it already, bring it forward. If you weren't hoping to buy it, you probably don't need it and don't buy it.
Absolutely, and especially now, cash is king. So, I mean, we're taking our tax planning with, through the lenses of, cash preservation as well. So all these things have to be balanced up with, seeing out the rest of the year. Maybe your business is going to reopen and see sales that might take a little longer to rebound as people slowly come back into their old habits. So, that's why you just make sure that, as Corey said, the money is going out. So we just consider that things need to be necessary before you actually pull the trigger on them. The last little slide I want to touch on, just in relation to what we look at in tax planning, is around tax brackets. And so what the big things are here is, when I look at a business, I usually look at the entire family group around the business. And the reason for that is you might have siblings, you might have other business partners who are on lower tax rates, you might be paying yourselves different amounts. And it might be worthwhile, all right, should we look at taking out some of this money from the business and bringing it into the family group at a lower tax bracket? So some common things are that we would pay a dividend out of the company, and you might have kids who are 18 who aren't earning as much. You might have a wife who is about to go on mat leave, and all of a sudden, her income's going to be a lot lower. So that's party time for you. So they're the sort of things that I would look at in a tax planning scenario. It's not always just about reducing the profit within the company. It's can we get the money out to where you can use it for, for investing through Corey, or, buying that home you wanted. Can we get this money out at a lower tax bracket than we usually would? So yeah, and I've got here that companies, will pay out dividends. If we're using a trust, again, we would just look to see who we can distribute to for the year. On the flip side, you might have a lot of income, and we would look at, distributing from a trust into a related company and capping the tax there. So that's a common strategy we also look at, where we have a lot of income and we've got a trust structure, and if you might have a husband and wife earning 180,000 each already. We've got a trust distribution coming through. We wouldn't really want to, pay tax of 47% in their personal name. So we might look at setting up a dumping company, as we call it, and parking some money there. So they're the sort of things I'll look at from a family holistic view of your business. You'd never look at just the business in isolation.
Yeah, well said. A dumping company, I'd always refer to it as a bucket company. But, I think I prefer dumping.
Yeah, I like dumping as well. Investment company, dumping company, bucket company, all the same.
Yeah, really well said. And I guess you're surface level on a fair bit of complexity here. Business owners, dependent upon the family structure and the business they have and the level of revenue and profitability they have, they're going to have different structures in place. And this is where your account becomes, even for me personally, ultra valuable in those months in the lead up to 30 June, and just making sure there really is some holistic planning across your different entities, across your family group, across the business. Also, and it's not just about tax minimization, as you say, it's about capital preservation and cash preservation, being able to run a good business into the future, not just be tax efficient at this moment in time. So, I think really has a few good tips there, Andrew.
Everyone's structured differently, so it's not a one size fits all, and that's why it's just important to basically see what fits you, see timing wise where your business is at, and what tax moves we can really make, and that changes every year. Right now with COVID, it could be a really great opportunity to take money out. That's what I'm seeing at the moment. Really, taking money out of a low tax rate, it seems to be a common strategy that a lot of our clients are moving on at the moment.
Well said. Well said. Andrew, that's a great rundown there. And I know we could have made this webinar much, much longer for business owners, but we wanted to make sure we're just addressing, I guess, the most relevant and most common things today. In terms of clients of ours that are watching this webinar that perhaps are business owners and maybe aren't getting the accounting advice and guidance and tax planning that maybe they should be getting, or they've got question marks around that, how can they get in touch with you or the team at One Ledger?
Yeah, very easily, Corey. So I'll just put some contact details here. Look, feel free to get in touch at any of those things, phone, email. Our website has a chat bot there that you can also get in touch with us through. And happy to discuss. Obviously, there's a few time pressures with 30 June this year, which we're used to. You might not be getting in contact with me just because I might be at the hospital with my newborn, but hopefully it will be me, and we can make sure that anything you need to do before 30 June, we get done.
Well said. Well, Andrew, I am on behalf of our team here at Verse and our clients here at Verse, we appreciate you taking the time to share your advice and your tips today. We know that you have plenty on your plate. I know that you've had to shuffle around quite a few things just to make this webinar work this week, given the planning you are doing for your clients. So thank you very much. We're grateful for the value you've been able to give us. I know plenty of the clients watching this are already clients of yours, but as I said before, if you feel like you're not getting the accounting advice that you might need or want, you're more than welcome to get in touch with Andrew and the team at One Ledger. They probably can't help you out this year, but in future years, absolutely. And best of luck to you and Danielle in the coming weeks, mate. Having been through it a couple of times now, they're the most magical moments of your life. And there's some sleepless nights ahead, but you'll work your way through that. And good luck to the Dons. I know the footy's back this week, and you're a big Dons fan. And hopefully they get off to a flyer.
Thanks, mate. I'll be leaning on you for some advice just around the newborn as well. But thanks, mate. Thanks for having me. And if anyone wants to get in touch, I look forward to speaking to you then. Thanks, mate.
Thanks, Andrew.